So we just did example number 2, which went through the entire life of this bond, 3 years, went through the journal entries. 2 things are changing from the last problem to this one. 2 things are changing. Everything else is the same. The first thing is when it's issued. Instead of being January 1st, it's now going to be April 1st. So April 1st, 2009, Lauren Industries issued $1 million. So this is still the stated amount. This is still the stated rate. Those have not changed. Interest is payable semi-annually. This time, obviously, it's going to be 6 months from April 1st, which is now September 30th, and March 31st. So this moving from January 1st to any other date is going to do a couple things. But one thing it's going to do is that on December 31st, we're going to have to do an adjusting entry. Obviously, we're making the assumption that we do financial statements on December 31st. So we're going to have a new journal entry that has to happen because we have a fiscal year end in the middle of a period. The bonds mature in 3 years. The market yield for bonds of similar risk maturity is 8%. This is our market rate of interest. The last time we had a 12% market rate, which gave us a discount. This time the market rate is 8%, we're paying 10%. Investors are going to be willing to pay more for it, and so we're going to issue this thing at a premium. So the investor is going to have to pay more than the face amount to buy this thing, and the issuer is going to get more than the stated amount at the issuance. So once again, I won't draw the picture because the picture is exactly the same. The cash flows have not changed. This number has changed, but the rest of these are the same. Why? Because these 2 numbers are what tell us these things. And so these 2 have not changed, therefore the cash flows stay exactly the same. So we still have $50,000 payments and then $1 million payment at the end. What will change is this issuance amount because of the change in the market rate. So this time we're going to have a present value of $1 million. Once again, 6 periods, but what is the interest rate this time? 4%, right? So half of 8% is 4%, and so this is going to change this to a present value factor of 0.79031, which gives us 790,310. And we're going to do the present value of an annuity. It's still $50,000. It's still 6 periods, but now we have the 4% interest rate. And that's going to give us a factor of 5.24214, which is going to give us 262,107. And that's going to be 1,052,417. And so last time it was less than the face amount. This time it's more because that market rate is now below our stated rate instead of above. And so the issuer, Lauren, is going to receive cash of $1,052,417. Leave some space, and then we're going to have a bond payable. It's still going to be recorded at the face amount of $1 million. The difference this time is going to go to a premium. Not the same premium we talked about previously, which is the gift thing that comes along with the purchase. This is a premium on bond, which is $52,417. What kind of an account is this guy right here? There's 2 acceptable answers. Lots of unacceptable answers, but 2 acceptable ones. Contra asset is not an acceptable one. Contra liability is not an acceptable one. Not contra anything. No contra. A liability is an acceptable answer. This is a liability, or another answer would be something that adds to a liability, which is called a adjunct liability. We all knew that, right? No. Liability is a just fine answer as well. This is an account that adds to a liability. So when we're talking about the carrying value of the bond, you add these 2 numbers together. It's the premium plus the bond payable That is the carrying value. So currently the carrying value is $1,052,417, the addition of those two numbers. All right, for the investor is going to pay out cash of $1,052,417. Is going to have an investment, could also be a bond receivable if you want, of $1 million, and is going to have a premium on investment of the difference, which is $52,417. What kind of an account is that premium? An asset or a adjunct asset. Very good. So it adds to an asset. Or it's an asset. It's a fine way to say it. All right, so that's the initial journal entries at issuance for both sides. At the first interest date, so remember, this one is going from April 1st, now we're September 30th. Since we have not had a fiscal year end in between there, nothing was really strange here. We still just are in the middle of a period, 6 months pass, and so our issuer is going to make a cash payment of $50,000, and it's going to record interest expense. How are we going to figure out the amount of the interest expense? What does the effective interest method tell us to do? Multiply. What by what? Carrying value, market rate of interest, time period. So, what's our carrying value? It's going to be the addition of these two guys. So 1,052,417 multiplied by the market rate of interest, which is 8%, and then multiplied by the time period, 6 divided by 12. And that's going to give us interest expense, interest revenue of 42,097. So interest expense is going to be 42,097, and the difference is going to reduce our premium. So just like with the discount, we initially create this account, and then throughout its life we get rid of it. So in this case we start with a credit, and we're going to debit it to get rid of it throughout its life. For the issuer, last time the discount was a debit, and then they credited it. Now it's the premium is a credit, and we're debiting it. And the exact opposite is going to happen for the other side. So for the investor, they are going to receive cash of $50,000. They are going to have reduced their premium, which is a adjunct asset of 7,903, and then it's going to have interest revenue, or interest income works as well, by the way, of 42,097. So in theory, none of what we just did right there is new. You learned all this before. Well, I take that back. You probably only did it from one perspective. You probably didn't do it from the investor's perspective, is my guess. All right, now we're going to do the partial period that we have to deal with. So this was September 30th, October, November, December. 3 months pass. It's now December 31st. We're making our financial statements. We need to do an adjusting entry. Why do we need to do an adjusting entry? Because we have incurred interest that we have not yet recorded. So we have to do an adjusting entry to put that interest in the correct period. This is also part of the effective interest method, is that we have, if time passes, we must record interest expense equal to the stuff we've already talked about. And so on this date, what is our carrying value? Carrying value has changed because of this journal entry right here. Our new carrying value is going to be the 1,052,417 minus 7,903, which is going to give us 1,044,514, and multiply that by, we're going to do the 8%. What's our time period? 3 out of 12. Which is going to give us interest expense of $28.90. All right, so for the issuer, we're going to debit interest expense of $28.90. Are we going to credit cash? No, because we make a cash payment. What are we going to credit instead?
Interest payable.
Interest payable, very good. So we're going to credit interest payable, leave some space. And that's going to be for how much? How much are we going to pay in cash in total for the 6 months? 50,000. So how much should we record for 3 months?
25.
25. So we're going to do half. So half of the total payment we're going to record as an interest payable on this date. Interest payable, 25,000. The difference is going to go to reduce our premium. 4,110. Similarly for our investor, they're going to record an interest receivable of the 25,000. Going to reduce the premium by that amount and going to record interest revenue for the 28.90.
Don't put one of these on it.
There is one of these on the test. Can I go to my next page yet? It's all right.
Okay.
Everybody else good? Okay, one sec. Kind of want to switch the page because I don't remember what's happening next. Yes, I remember now. All right, so this is the journal entry December 31st. So what we need to deal with now is what happens when we make our next payment, which is going to happen 3 months later. So when we get to April 1st, we're going to make our next payment. So let's figure out what that's going to look like. So at our second interest payment, we are obviously, just like before, going to make a cash payment of $50,000. But we're only going to need to record interest expense for the 3 months. And so the 3 months is going to be equal to what we recorded last time. So a good way of thinking about this is basically what we did was we had a full 6 month period, but we just chopped it in half. Half of the interest expense before December 31st, half after. So we're going to record interest expense for the same amount we did in our last journal entry of $28.90. We're going to get rid of the interest payable that we created because we're making this cash payment. Interest payable goes away. We created a $25,000. At the same time, we're going to get rid of the rest of our premium, which is another $4,110. The best way to do these problems, and you're going to see this when we do our table, is basically figure out what it's going to look like for the full 6 month period, and then just chop the journal entry appropriately into the 2 different periods. So in this case, it's chopped in half, but it could be 1 month in the first period and 5 months in the second. Then you would just take the total amount of the premium that's going to be amortized, take 1/6 of it in the first period, 5/6 of it in the second period. Same thing with the interest expense, 1/6 and then 5/6, or 2/6 and 4/6. So however you separate it between the 6 months. In this case, we just split it in half. Similarly, for the investor, the received cash of $50,000 is going to reduce the premium by 4,110. It's going to record, so I'm going to get rid of the interest receivable. 25,000 is going to record interest revenue of $28.90. So essentially, we just chopped it into the two 3-month periods. Yes?
Yeah, are we going to provide a table in the exam?
I will not give you a table. You could feel free to create one on your own if you would like. You really won't have to because I'm only going to ask you for the first and second. In fact, I'll tell you exactly. I think it's just the first 2 interest payments. So you won't really need to. You can if you want, though. Let me find this exam. Yeah, first 2 interest payments. First 2 interest payments. So in both cases, it's just the first 2 interest payments. So you won't have to make a table, but if you needed to, you could. But I won't give you a space to do that. There's plenty of, you can use the back and you can write on it if you want. So there's space to do it, there's just no table.
What was the question?
Question is, is there going to be a table that you fill out on the exam and interest now? You'll just be asked the journal entries. All right, so let's go ahead and look at the amortization table. So 4109 is the issuance date, and we issued it at $1,052,417. We made our first cash payment, which we recorded on the previous page, of $50,000. Our interest expense was $42,097. We amortized our premium of $7,903, and so we had a new carrying value of $1,044,514, which we've already figured out. And then we had in between here a journal entry, but for the full 6-month period, which goes and ends at 3/31/10, which is when we make our next cash payment, the interest expense that we're going to record is a total of $41,781. All we did was we took this number and divided by 2 to get this and the one that we had on the previous page, with a little bit of rounding issue that we'll ignore. And then the amount of premium we amortize is 8219, which again is just being divided by 2 to get this number again with rounding, which we'll ignore. So what if this were 3 months and 3 months? Then, let's say it's November 1st is the beginning of our next period. So it'll be November and December. Then we would take 2/6 of this, and we'd amortize that on December 31st. And we'd take 2/6 of this, and we would have interest expense of it. And we would take 2/6 of this and create an interest payable for that amount. An interest receivable, again, who we are. And then on the next period, it would be 4/6 of this, 4/6 of this, and then obviously we would do the full cash amount on that date. Questions on that idea?
Why do you ask?
What's that?
I said, why do you ask? No, I'm just kidding.
Why do I ask?
Well, I mean, never mind.
Is it obvious that everyone has a question, but no one wants to ask it? Is that what you're saying?
No, that's, never mind.
All right. 3/31/10. Our new balance is 1,036,295. After that journal entry we just did right there. Yeah, maybe it is too late to ask this question, but we'll see if anyone knows the answer to this. So when I first learned this back many years ago, I was sitting in a classroom, just like you guys are sitting in classrooms. I don't even remember who was teaching it. I'm sure it was a great professor. I don't remember. Back in BYU, it was in Provo, Utah. And I was learning this, and I said, and I think I even raised my hand. I might have gone to them after class, but I think I raised my hand in the middle of class and said, "No, you're doing that wrong." I said something to that effect. Because they had just taught me that interest expense is the carrying value times the market rate times the time period. And this interest expense right here, that's not what we did. Do you see that that's not what we did? Because what's the carrying amount as of that date? It's different, because we just got rid of some of the premium. So why didn't we update that I forgot the new interest expense. Do you see what my concern was? Did any of you have that concern? It's too late, I understand.
Yeah, I did.
So, what did the professor tell me? Well, they explained it to me, and the reason that this doesn't change is because we actually only change the carrying value when we make a cash payment. And so, since there was no cash payment here, we didn't actually change how much we owed. We still owe the same amount. This is just an adjusting entry, and we had this interest payable that shows that we actually owe more, not less. We haven't made a cash payment to reduce how much we owe. And so this premium has actually not changed. That's the reason. If you didn't wonder, you can go on and not wondering, but that's the reason why we don't change that. We just split it up. 6-month period, we only care about cash payments to actually adjust that. All right, so I'll just fill in the rest of these. I think you probably know how to get to them. So do you see now why I only did 3 years instead of 10? That could be a lot of rain. All right, I'll give you a minute to copy this down. We're actually end up being $5 off at the end, but that's just because of rounding. If on the exam, well, you wouldn't know. Don't bet. Yeah, so during the summer, one of those intermediate classes is a morning class. I haven't taught a morning class in years, so it's going to be strange. I don't think I've taught a class before 4:15 in at least 2 years. So it'll be weird teaching a 10:30 in the morning class. That might not be true. I might have taught an intermediate in the summer earlier, but not much earlier than 4:15. All right, so when we get to the end, just like before, we end up with just the bond payable and the investment without the premium. The premium is gone by the time we get to the end. So just like we did last time, I'm going to go ahead and record the journal entries for the issuer here, and on the next page we'll do it for the investor. We're going to do both the journal entry for the interest payment and also to pay back the principal. We'll do both of those. So because this is a 3/31/12, they must have just done a 12/31 adjusting entry. So we're going to take that into account when we do this journal entry. So when we do this journal entry, we're just going to record half of this number right here. So we'll have interest expense of 2192. We're going to get rid of interest payable that we must have created on December 31st, so 25,000. We're going to get rid of 1/2 of this premium, the other half of that guy right there, which is 4808. And incidentally, when we do that, the premium is now gone. That's the last of the premium. And we're going to make a cash payment of $50,000. When we do that, the premium is now gone. All that's left is this bond payable, and so we make a cash payment of $1 million, and we debit the bond payable, and we're done.
So the half of interest expense is from beginning of 2012 to March 31st. That's why it's half, right?
Yeah, so it's 3 months worth, January, February, and March of 2012.
Okay.
So 3 months before the fiscal year end and 3 months after, so we just split it in half in this example. But, if it got separated a different way, you have to separate it appropriately according to how many months are in each period. All right, and then for the investor, very similarly, we want to debit cash of $50,000. Going to credit interest revenue of $21.92. Going to credit interest receivable because we've not received it, so we're going to get rid of this, $25,000. And we're going to reduce the premium by what's left, which is $4,808. And then last but not least, we received cash of $1 million. And get rid of our investment of $1 million. All right, to try to tie a couple things together. So first of all, half of what we just did here, the part with the investment, would normally be in chapter 13. And if you want to go back and see examples of that, you have to, no, it's not 13, it's 12, right? It's investments 12? Okay, you have to go back to chapter 12 to see examples of that side of all the journal entries. Obviously, here in chapter 14 is going to be the side from the issuer. So I hope you see how these are all always mirror images of each other. So on the exam, you're going to need to know how to do it all from one perspective or the other. Because for one of them, I'm going to ask you to do it from the perspective of the investor, and one from the issuer. And one's going to be a premium, one's going to be a discount, none at face value, too easy. And then for one of them, it's going to be partial periods, just like we just did. And then for the other one, you're going to do it first, just the way we did with the effective interest method. And then you're going to do it again using the last thing that we're going to do in just a second, the straight line method. You can see the straight line method's really easy, so it's really not that big of a deal. One more thing that we'll do before we talk about the straight line method is, I forgot to talk about this guy on the top of here. So this is for the one for the discount, we'll talk about the one for the premium as well. Since less cash is paid each period, the less cash than the effective interest, the unpaid difference increases the outstanding balance of the debt. So this was the reasoning I was trying to get to earlier. Because this number is bigger than this number is going to increase each time. Similarly, for the premium, since more cash is being paid, $50,000 versus the $42,000, more cash is being paid each period than the effective interest, the additional amount paid decreases the outstanding balance of the debt. So we started a number greater than the face value, and we moved down because these cash payments are larger than the interest expense and interest revenue that we have to record. That's the reason for that. All right. Let's go ahead and do this last thing, and we're going to be done early. Isn't that fabulous?
Yeah.
It's pretty fabulous.
Thanks.
The straight line method. In some cases, firms are allowed to amortize equal amounts of discount or premium throughout the term of the bond. So basically, instead of using the effective interest method, which is what we've done with all of these problems so far, in certain cases, you don't have to do it. You can use a simplification, and I'll show you the simplification in a second. The only time that you can use this straight line simplification is that if the results are immaterial between using the effective interest and this method. And that's only going to be true in a couple cases. It's going to be true, number one, when the market rate and the stated rate are very close. That's going to make any premium or discount very small, and any difference between the effective and this almost non-existent. It's going to be so small it won't matter. It's going to be pennies and no one cares. The second reason is if your debt is very small, the difference between this method and the other one is going to be so small it won't matter anyways as well. Those are the two big reasons why you might use the straight line method. In both cases, the results, the difference is so small, no one cares. And so you can go ahead and do this easier method instead of the effective interest method, but only when it doesn't matter between the two. So basically what we're going to do is we're going to use the example of the problem we just finished, this guy right here, and we're going to say, what if instead of using the effective interest method like we did, we use the straight line method? Well, the straight line method is very straightforward. So 4109, 1052, 417. Essentially what you do is you take the amount of the premium or discount, in this case we have a premium, works the same way as with the discount. We have a premium of 52,417. You're going to divide it by the number of periods that you're going to amortize it, which is 6. And we're going to get 8736. And you're going to amortize the same amount every single time. And so here we have 9/30/09. Let's put these dates in real quick. The cash payments, as we already know, always stay the same. Just like in the previous two examples, cash payments always 50,000, but that has not changed here. But now, this premium stays the same every single time. The amount we amortize the premium stays the same every single time. So what is this number? What's going to happen with this number? It has to be the same every single time as well. We're going to get 41,264, 41,264, and it's going to be the same number every single time. So using 41,264 violates the effective interest principle or effective interest method. Why? Because if we take our carrying value times the market rate of interest, we do not get this number. We don't. And so it's only acceptable if the difference between this and what we use under the effective interest, the difference is immaterial. And so the balance is going to be whatever it ends up being, this minus this. And I'll put these numbers in here real quick, just for completeness. And so the journal entry is going to look exactly the same as last time, but with these numbers in it, and the interest expense is going to be exactly the same amount every single period. The amount of discount, premium in this case, that we amortize is going to be the same amount every single period. We'll do partial periods the same way. We'd split half into one, half into the other, just like we would in any other one.
This one again now. When can we do this?
But if the difference between this and the effective interest method is immaterial.
Which one?
The effective interest method, which is what we've done the rest of the time today, if the difference between this and that is immaterial, then you can use this. It's just easier. That's the only reason we would use this. The difference between the effective interest method, the method that we've used up until now, which is always taking the carrying value times the market rate of interest times the time period to get us our interest expense. This doesn't do that. And if as long as the difference between using the method and not using the method, using this method instead, as long as those numbers are immaterially different, you can use this method. So most firms are going to use the effective interest method for almost all of their debt, and this will only be used in particular cases. So, for example, let's say that we have a stated rate of 6% and a market rate of 6.02%. You could probably use this method, because we're going to be talking about pennies as differences, and no one cares. So in that case, you probably just default to this. Any questions about any of that material we've gone through? Any questions about what the bond questions are going to look like on the exam? Okay, you make my life easy. 20 minutes early. You are free to go. Good luck studying for the exam. If you have any questions between now and next time, feel free to send me an email. I'll probably be here a little bit early this time, so if you have questions before